last time that I spoke to them, they were heavy proponents of the can-slim approach of investing. The last two times, in fact, that I spoke to them, their performances pre-COVID that I remember were very good, top of the charts. And I reckon that the performances in the ensuing 2 years wouldn't have been too different. I've spoken to them from multiple geographies, with both of them being at different geographies and the same geography at the same time. And it's lovely to have both of them again, the co-founders of Girik Capital, Charandeep Singh and Varun Daga, to talk about how is it that they are adjusting their investment philosophies, positioning, sizing, what have you, in the current landscape, which is as uncertain as 2020 or 2021 were. Gentlemen, both of you, thank you for joining in.
Good morning and thank you. And good morning to all your viewers.
Thank you so much. So either of you can start, but I'm just wondering, has your investment thesis and the way you approach picking up stocks changed ever so slightly or majorly in the wake of the fact that the world seems to be a different place almost every single year in the last 3 years?
I think that's a very good point, Neeraj. The world seems like a different place every year. I mean, 2 years ago, we were struck by COVID. Now you have this whole commodity crisis because of Russia. And you're right. I think so much has changed in the last 2 years, and it's such a dynamic world. So, of course, it makes investing all the more exciting, rather than challenging.
Yeah, that's true. But Varun, that's the question. I mean, so if you were approaching investing in a particular framework, have you been forced to change that framework simply because of COVID, supply chain disruptions, and now the geopolitics?
So, Neeraj, it's very interesting. We talked about our style earlier, but the style is designed in such a way that it automatically adapts to change. Because the way we look at our screeners, it's also designed by a lot of price element, and we actually look for leadership not just in terms of earnings but also in terms of price. And a lot of times, price actually gives you those early signals. Like we saw in metals. I mean, the metals were on the screeners just as the COVID hit. And, after a year today, we know that, okay, what's happening in the world, and it's helping the metal cycle. And that makes the cycle even more stronger. So I guess, the way our screeners are designed, it takes into account all these changes, and it lets us be very unbiased, so that whatever comes up. I remember when metals came and Charandeep and I were talking, I'm like, we've not looked at metals for a decade and they've not done anything. How do we do this? And, it took us some time to understand these companies, but we realized that, yes, something could be happening here. And it was so funny that a few, weeks ago, we saw one of the aluminum company, one of our largest holding, and we were like shocked that, one of our largest companies is a metal company. But it just happened naturally because, the way our style works is we cut our losers and we ride our winners. So, and that's what we try to do.
Yeah, I think the list, both globally and locally, has changed quite considerably in terms of winners and losers compared to what it was maybe over the last decade. As Charandeep, I think you were telling me yesterday on WhatsApp, right, that suddenly when you run screeners, you realize that, you didn't quite see this in the list of winners or losers in almost each year of the last decade. And suddenly these names have started to pop up. How do I say, how challenging? It might be interesting, of course. I'm sure it becomes challenging as well, right? To, for example, learn metals kind of all over again, so to say, because you didn't look at them for a decade. So how challenging is it becoming to kind of going out and identifying and accepting that maybe you need to bet on some things that you haven't looked at for such a long time?
The challenge is an exciting challenge. I'll keep saying that again, because what happens is, anecdotally, markets are just designed to do this. They're genuinely designed to surprise you and surprise the human mind. These challenges all exist in the mind, right? So let's go back to the first decade of the century. It's so funny that I'm calling it the first decade of the century. It sounds like a really long time ago, but for people who've been in markets for 20 years plus, they will remember that period from 2001 to 2008. You had a very different index composition. We ran some analysis for our investors just last week, where we noticed that oil and gas was 25% of India's indices in December 2007. It was the largest company. And today, if you just strip out Reliance's other businesses, it's probably 4 or 5%. So imagine how it's collapsed, right? Similarly, financial services was 8 or 10% of the index back then. And it peaked out at 42% just pre-COVID, in the months before COVID. So just imagine the challenge that the human mind had to go through to readjust portfolios even then, right? You had to suddenly downweight ONGC, you had to downweight your metals exposures, you had to downweight so many stocks. And then, so if you look at any of the large mutual fund houses or the large PMSs, during that period, they probably had all these stocks as part of their holdings, right? The ONGCs, the Hindalcos, the Tata Steels, the cyclical companies. Because if you ran screeners for the last 10 or 15 years, then they look like the high ROE, high growth companies. Point is that keeps changing. And I think that changed between 2012 and 2020 as well. You suddenly had the high ROE, high growth pack shift into consumer and retail private banks, largely. People forgot the corporate private banks. I mean, they were the large index heavyweights, 2007. So to the point that Varun was also making, that the screeners are, you need to listen to price sometimes just to observe what's happening in the markets. Things are changing and things are taking place. All you have to be very open-minded at that point, even though it looks very difficult to go out and research a metal company from scratch, given that you are so conditioned to believing that these never make money, But, Hindalco, for example, for us, and I'm not recommending it, it's not advice, but it's been one of our largest holdings for the last couple of years. And it's worked out nicely, obviously. Many haven't, some have. It's normal in a portfolio. So it's interesting how these things tend to work out sometimes. As long as you're open to listening and open to consistently doing hard work and doing the research, there's always something to be done and some money to be made somewhere.
Okay, so I'll get into the nuts and bolts and the micro in a bit. First, a couple of questions on the macro. Charandeep, are you guys sitting on some bit of cash waiting for the uncertainty to result in a downdraft, or are you guys fully invested currently?
So look, we are largely, we largely try to be fully invested at most times. And if we are not fully invested, it's because for two reasons. One is, of course, we're waiting to find new ideas, new names that we could ride. But it's also because we've cut a lot of our losers. We're very aggressive with taking losses. We don't like to let our losers run. So, generally, as risk management is a very high priority at Girik. So we do that regularly. And, if that results in cash being accumulated in the portfolio, so be it. It doesn't normally last long. We usually will deploy it at most.
Okay. So even it's safe to assume that currently as well, you're kind of close to fully invested. You're not sitting on large pools of cash to invest at lower levels. You're not trying.
I would say that we're sitting on above average cash levels right now.
Oh, above average cash levels. Okay.
And that's only because we sold out of some of our older winners, or took some cash in loser stocks that didn't work out for us.
Okay, so just a follow up, and then I'll get to Varun. But is this a tactical call in order to also anticipate a corrective move in the market, or is it a factor of what individual stocks were telling you? Charandeep?
Yes, you're right. It's totally a factor of what individual stocks were telling us. So it was not a market-based cash call at all. We don't generally do that.
Okay. Varun, if I may ask you, are you guys, because you brought up the point of screeners and price being the early indicator, predominant factor, what have you? I don't want to misquote you, but are you at the current point of time trying to take, for example, some thesis around decadal calls or 2-3 year calls as well? The reason I ask this is that, being into expensive NBFCs or being into expensive spec chems, as per CanSlim, might have worked really well, presumably, and they ran for 3-4 years or 5 years at a stretch before kind of peaking a little bit. I'm trying to understand that currently, is it too volatile to take a period to take calls like that, or are you finding opportunities which could be long lasting and you will give or take a little bit of a leeway even if price doesn't kind of go in your favor?
Sure. No, so Neeraj, look, taking a 10-year call is very, very difficult, We have held stocks for a long period of time, but I think when you start off, you can't say that, okay, I'm going to hold this stock for 10 years, right?
Agreed.
Out of your 5 stocks, maybe one could be that company which you want to hold for that long. but I don't think we start off like that. But yes, what we see, and we've observed it after every correction, that the leadership does change. We saw that during COVID. You saw the IT and metal names come up out of nowhere, and you really saw the re-rating. The bull market actually started with the IT companies, not just the large ones, but also the mid cap names. Even on the metal side, for after more than a decade, we saw them coming back. So after every correction, we see some of these new leadership emerge. It could be a small sector, let's say, like the ethanol story we are listening about, right? Or it could be a large sector like a IT sector. So yes, we do keep looking out for these sectors, and I think it's very important to be in the right sectors, because like Charandeep said, if your half your job is done if you're backing the right sector. If you were in consumers and private banks in the last decade, I think you'd have made money. You would have picked the right stocks automatically. Similarly, if you're in the right sectors for the next decade, uh, you will pick the right stocks. You will pick the leaders. It's much easier to buy a leader of the right sector. But I think it's more important to understand how the dynamics is changing in a sector. So we do a lot of work while identifying a sector. So right now, what we again see, the ITs and metals still leading. We do not see that much, leadership in the consumer names, because they do get affected by inflation and cost pressures and demand destruction if they increase prices. So it's important to see which sectors are we focusing on, and I think we are still sticking out to some of these sectors that came up in the COVID.
Yeah, but actually, that was sorry. So I'll kind of rephrase that. What I meant to ask was that are there? I'm not saying you enter a stock with a decade long horizon. Who knows? You have investors' money to manage. But what I was trying to think of, that are there themes which are looking like long term in nature? Forget the terminology of a decade. Are there themes that are looking long term in nature getting formed currently? Because a lot of people, like you said, ethanol. A lot of people are betting on that being a slightly longer term opportunity than just the immediate term. Somebody was talking about the manufacturing renaissance. God knows when it comes, but somebody's talking about that and how that will really usher in a lot of manufacturing companies within different sectors do well. Textiles is emerging as a theme, which a lot of people say looks slightly longer term in nature this time around. So I'm just trying, and IT, as you mentioned. So I'm just trying to understand, are you finding opportunities in this current volatile times which are looking longer term in nature? And you will, of course, churn your portfolio as and when the prices tell you.
Sure. No, absolutely. We are seeing themes, and you talked about these names, right? So I think you hit it right. It's IT, it's the ethanol story, it's some of the metal names. We're also seeing some of the old economy names, like the capital goods sector. So we are really seeing the capex cycle ahead of us, right? So as more and more of these companies go into a capex cycle, many of the capital goods name could be a long-term story. So and obviously we are finding individual stocks in each of these sectors that could benefit, which should have a leadership run by good management. So obviously all the checks. But yes, I really think that there is one can see a large opportunity in some of these sectors for a long.
Okay, so with your permission, gentlemen, a slightly different conversation than what Alpha Moguls is, but I would love to probe 3 or 4 of these themes, if you will. We don't want to make any recommendatory conversation out here, but just to understand how you guys are thinking about some of these themes. So may I ask you, for example, IT. Piyush Goyal was on record saying that IT exports could become $1 trillion opportunity. Now, my question is, do you guys foresee that in your conversations with management and corporations around the world? And if so, whether it's $1 trillion or what have you, but if you believe this is a longer term opportunity, how are you playing it? Large cap, mid cap, a mix of both, bias towards the expensive ones, even if bias towards the high growth ones, even if they're expensive, or buying value within IT. Can you tell us a bit about how you're playing IT?
So, Neeraj, I think I'll try to break this question down because there's, maybe there are a few questions and one question's about the IT sector. So, if you see what happened during COVID, until pre-COVID, the sector was really not seen as a very high growth sector. There was some maturation element to it, as we all know. And it also, the multiples had contracted a bunch. Okay. And I don't think you had a growth across the board, across the larger names and the big names. I think that changed after COVID because I think everyone rushed at that time to get onto the cloud largely. So cloud became a very large opportunity. And if you see with Infosys, it's now what they define as new age or cloud, digital, SMAX, analytics, all that is close to 60% of their revenue base and growing at a very fast pace. So someone like Infosys is clocking 18 to 20% volume growth, which is quite ridiculous for a company with a market cap as large as it is, right? So it's clearly telling you that there's a rising tide, right? And pretty much a lot of the large names are going like that, especially the guys who are the digital enablers and who identify the opportunity quickly. So, people will understand from their own usage of apps and phones, their own, Zoom calling, so much more is happening. Every business worth its salt needs to get onto an app or needs to get onto the cloud because there's no other way to do it. After that comes a whole bunch of analytics that you can run because you have digitally enabled customers, right? So if you look at the entire fintech universe today, it's changing so dramatically in front of all of us, right? And I think that's happening in even the smallest of industries. So that opportunity is secular. I don't think that industry opportunity is going away anytime soon. It's probably one of the most visible opportunities out there, right? Now, if you look at the larger names, like I told you, they're probably growing anywhere between 15 to 20%. The smaller names, the mid-sized names are growing faster. And of course, there are smaller companies over there that provide different types of services like ER&D, right? So, the way we designed our portfolios, we had one of the larger names. We had a mid-cap name and we took on board some of the risk that comes with taking on ER&D names, because we thought that's a very dynamic, high growth sector. So we've been looking at it like that. We've been straddling across the market cap spectrum, across different products. But what's easy to do here is the bellwethers themselves are growing so quickly. So it's quite a long runway for growth, and it gives us a lot of opportunity for stock picking.
The thing, Charandeep, is that there is a bit of a striking difference in the valuations between the bellwethers as well, right? What a TCS or an Infy are doing versus what a HCL Tech is trading at. I mean, I can ignore Wipro because of the lack of growth. I'm just saying there's a bit of a dichotomy out there. And then if I just look at the broader end of the spectrum, those are companies northwards of 40,000 crores of market cap. So they're not small caps by any means. And they are growing anywhere between 30-35% as well. So right. I'm trying to understand what is your argument when you're picking one over the other?
I think, to be very honest with you, it's very difficult. When there are 30, this reminds me of the time when in the last decade, there were like 30 private sector banks and 20 NBFCs all going up in price and everything was making a new high and earnings were going through the roof. I mean, that continued much longer than we anticipated, Now you don't find that, by the way. I think post-COVID, it just settled that score quite easily. There's 3 or 4 guys growing the earnings. Most people are struggling. Probably something like that will happen, but it's a long way off, a rising tide lifts all boats.
Okay.
And I'll tell you, it becomes hard, right? Understanding the idiosyncrasies of one business over the other is not so easy. But one thing we rely on, right, is the management, right? The guys running the business, how much common sense they talk, how much governance, quality of governance, depth of management, talent pool, ability to retain talent. These things are very important. And, I tell you, the leaders will always continue to disproportionately take share away. That's going to happen. So, which is why I said, you stick with the leaders, the bellwethers, whichever one you want to buy, you decide. वो आपका comfort है management के साथ. That's your ability to decide that, okay, I like this guy. I think these guys are doing a great job. They're good governance, whatever your parameters.
Got it.
So I think that's the way we look at it, and we've chosen our basket. So I think we're going to stick with it for now.
Got it. Varun, you made an important point about old economy companies, manufacturing. I was talking to SKF, who said that this decade, if I was a manufacturing company, this would be my decade, and it would be much different than what the previous one has been. But manufacturing is a very wide bucket, multiple industries, multiple sectors, multiple themes. How are you guys, or what is it that you guys are narrowing down upon, and why is it that you're doing that?
No, that's very true, Neeraj, because you can choose many baskets. You can choose the consumer basket in the in the in the cap goods sector, like the bearings or the abrasives, which you need to use every time, which we feel is a very exciting space, and we're doing a lot of work there. So the thing is that as your capex increases and more and more manufacturing is done, you will have to use some of these capex linked consumer companies, in that sense, where you have to use the bearings or you have to use the abrasives, and there are very few players in that. So one also needs to see that an industry which is supposed to grow, and which is and there are only a few leaders there. So I think one needs to break it down in such a manner where if the upcycle comes, few companies tend to gain a lot of or tend to take a lot of that market share. And if the upcycle doesn't come, you don't lose much, because these are anyways companies. So I think one needs to, especially on the capital goods sector, because it's very easy, some of these capex to get delayed, because they're also governed by a lot of macro factors. But I think important is that which sector do you choose, which area do you want to be in. So for example, we talked about the ethanol story, right? So now if there is a cap good company which supplies machines for these, the capex is coming, everyone's announced it, right? If there is a company that could supply the machines for that capex, then that could be an interesting story. Let's say textiles, if there is a massive growth in textile, if there is a cap good company which is a leader in that space, is supplying to. So we need to find that leadership. It cannot be a very, very crowded space, but wherever there is leadership and there is end market demand and end market capex very clear, it makes a big difference. We saw that with the chemical sector. The last 4-5 years, when the chemical sector did well, the companies that were helping them do the capex, the reactors or the other things, where there was leadership, they tend to do so well, and the multiples and the price went through the roof. So I guess one needs to find opportunities like that. And even on the mainstream, we have some of these large companies which are the old economy, the oil and gas. I mean, they're trading at multiples which is very, very cheap, but you can't really get into the value trap, right? They've always been cheap for some time. For us, it's very important to see whether the money flow is really shifting, right? We saw that in IT, how the money flow started moving from the financials into IT. Similarly, we need to understand if the money flow starts moving into some of these old economy stocks, like the ONGCs of the world, and that's when your multiple starts to re-rate, and slowly it becomes a consensus. So I think the idea is to having an open mind. When the earnings starts to accelerate, and when people start believing that the tail is long and the earnings will keep growing, that's when that's when your multiples start to go higher, and that's when money flow starts coming in.
Okay, a couple of quick follow-ups there, Varun. So Ruchir's article was interesting, right? When he's saying if data was the new oil, maybe oil is the new data of this decade. He certainly seems to believe money will flow into energy because the world is underinvested. I'm asking you, are you sensing that money will flow into energy world over and in India as well? And therefore, is it prudent to bet? I mean, there's always value here, but do you reckon the money is starting to flow into energy?
We feel so. I mean, last couple of weeks, Charandeep and I have been discussing about this, and we see that globally it's happening, right? We recently saw Warren Buffett invested in a company. So I think it's very clear that it is happening. Early days, and we need to see that it sustains. But I think it's a very, very interesting theme. Everybody is so underinvested here, and it has played out in the past, so it could happen again. But I think what we need to see is that can it sustain, can it continue, and can the growth be there? Because ultimately, money will chase earnings and growth and the sustainability of earnings. So
Yeah, and then just a quick follow-up, and Charandeep, feel free to come in, of course, but Varun, just a quick follow-up. You mentioned ethanol. You kind of gave enough hints to us, but I'm just trying to understand. Would you look at the machinery end or the capex suppliers on the ethanol story? Because it's promising with Nitin Gadkari saying that, hey, why can't we go to 4,000 liters? Though I mean, it might be as difficult as it may sound. So are you looking at the principal cap good companies which are machinery suppliers? Or are you comfortable looking at ethanol suppliers themselves, because they are both sugar and non-sugar companies which are becoming ethanol suppliers?
We're looking at both, Neeraj. I mean, we're looking at both on the machinery side and the leaders. See, I think what's important is that you pick the top 2, 3 guys. Because ultimately, everyone's. In fact, you'd pick the top guy. You don't have to even go down the third, fourth, fifth sugar company, because the best will perform, and ultimately he will make sure that it's run well, the raw material supplies, everything's taken care of. And also governance plays a very, very important role. You don't want a company to earn the money and not pass it on to the minority shareholders. So look for companies that have done buybacks, that have a clean capital structure, clean balance sheets, who have the ability to do large capex. So I guess the larger ones would be the right ones to look on the sugar side. And on the capex side, you don't have many names. So
True that. Okay, final couple of questions, gentlemen, before we let you go. We've taken about 25 minutes. 2 more. Charandeep, to you first.
Sure.
BFSI, the weightage has certainly peaked and come off quite considerably. The overarching hope and maybe a belief of some of the people is that this could be a year for banks, because earnings growth would be possibly visible. And if the capex story takes over, then banks would naturally benefit. You concur, you differ, why or why not?
I don't know about 1 year, Neeraj, but I can tell you that there is a disruption happening. It's very evidently clear. I think India for the last 20, 30 years has benefited from the under-penetration of financial services, number one, and number two, privates taking away share from publics. These two themes have been all prevalent. I think that's very much played out. These are good companies, they're good banks. Will they earn the ROEs they used to in the past? I highly doubt it. My challenge is on the fee income side. You have most of us now choosing to make payments from a Google Pay or a Phone Pay. They're not using our banks anymore. It's too difficult. So haven't they missed that? Haven't they missed a simple trick? Will they be able to fight back? It's not so easy when there are going to be so many new competitors. I would be arguing in favor of or on the side of disruption, saying that disruption is going to take away earnings stream over time, right? You could have one more Bajaj Finance or 2 more. On the other hand, I would say if you get a bank that is nimble, or you get a large financial institution that is nimble, then you go stock picking. You find that one guy who's able to keep pace, to make changes, to disrupt, to be large, to be quick, and to find new streams of income, like Bajaj Finance did over the years, right? Nobody thought they would succeed, and they continue to spoil the market and take away, parts of the market, largely because they're backed by a really good management team. So I would say again, focus. Yes, the banks as a big basket, I wouldn't want to play. But I would say find 1 or 2 guys who could really continue to take share and do something different, be it on the corporate side, be it on the retail side, whatever it is. Yes, I would find 1 or 2 names that I could back if those exist. But otherwise, I wouldn't be in favor of that backing 34% of the index in financial services to continue over the long term.
Interesting. Thanks for that, Charandeep. Final question to you, Varun, and that's on consumer tech or all forms of tech. They made a splash in 2021. They've kind of gone off the boil quite rapidly in 2022. Is it a factor of what happens to NASDAQ that makes you choose these at an appropriate time? Or do you find value here?
So I think, yeah, Neeraj, a great question. And I think one can argue what is value here, because many of these companies still don't make money, but they've built a very, very large and robust business. And we're hoping that in the long run, they do make money. But yeah, I guess what happened in the fall, and many of these companies got crushed because, they were very, very over-owned, or everybody got too excited about them. And that's what happens, when there is a bit of euphoria. You saw NASDAQ went up some 10 times in the last 10 years, and a lot of free money was floating around, going into all the tech companies. The private equity money was again so much there, which was, going into the tech companies. So I think a lot of consolidation will happen. We might see some kind of time correction because before some of these companies will come and lead. But my sense is that you will see 2-3 names which will become quite big here. They might take time. A lot of supply is there. So when many of these anchor book opens, and many of these the guys, private equity guys who might need to exit, so a lot of supply still might come, and that might make the stock range bound for a very long period of time. But I'm pretty sure that some of these companies will come and lead, and could become big winners, because they have clearly disrupted the market. And I think what's interesting is they're still growing very fast. So on the sales front, they're growing fast. And I also feel when there is a correction like this, new startups getting funded will become a little difficult, right? So competition will ease out, and these guys are already sitting with a lot of money. So I think one needs to pick leadership, and one needs to pick and one thing we always talk about in consumer tech is look for frequency, because those are the companies that become very large. If you have to open an app once in 1 year, I don't know if it's going to survive, right? But if you have to open an app every day or every second day, that makes a big difference. So I think if you see most of the largest consumer company globally, how frequent you are on that app, right? Whether it's Google or Amazon or any of these, you pick any of the Facebooks of the world or Instagram, because you are so frequent on those apps, it's just become very, very large, because you're that much closer to the customer. So I feel that I think that's one theme, and we always look for the frequency in the use of the app, and because that creates that habit and that moat around the story. So you can see a lot of these companies that have listed and look for which of those have the frequency, and then everybody can value it in different ways.
Of course.
So there are multiple ways to value.
Yeah. That's what makes this space even more exciting. But gentlemen, lovely talking to you. It's been a while, but great having you. Thank you so much for your time and for your wisdom.
Thank you so much.
Thank you. Wonderful. Great chatting with you, and have a lovely morning.
Yep. Thank you. And to everybody, thank you for tuning in, and to all the Parsi friends, Navroz Mubarak.